Most retail traders operate under a flawed assumption that the secret to profitability is wrestling their internal demons into submission. They obsess over suppressing fear and greed, treating their own psychology like a volatile threat. Treating the mind as a liability is a strictly defensive posture. That model collapses at the institutional level, where managing billions of dollars demand precise systems that transcend basic emotional control. Dr. Brett Steenbarger has spent decades consulting for high-frequency trading firms and hedge funds, managing portfolios deep into the hundreds of millions. Through that work, he realized that elite performance requires an entirely different cognitive framework. His approach didn't start in clinical pathology, diagnosing what is broken. It began in philosophy. After reading Ayn Rand's The Fountainhead, Steenbarger identified a new role for psychology: the systematic expansion of heroic human potential. Applied to markets, the top 1% of participants do not succeed by deadening their emotions. They succeed by mapping their natural cognitive constraints and ruthlessly adapting to the statistical realities of the order flow. This matrix represents the cognitive architecture Steenbarger uses to map trader development across 4 pillars: adapting to regimes, building on strengths, cultivating creativity, and developing best practices. Once internalized, psychology stops being a shield to protect you from your own mistakes. It becomes a generative engine designed specifically to extract alpha. The highlighted quadrant in this matrix represents the first pillar, adapting to regimes. It answers a question every trader eventually faces. Why does a strategy that printed money for 6 months suddenly start hemorrhaging cash? The instinct is to assume you have lost your nerve or your discipline, but often the error is logical. You are executing perfectly, but the underlying physics of the market have shifted. This chart illustrates asset behavior during periods of high implied volatility. When the VIX sits comfortably above 20, markets move with velocity. Trend persistence is strong, and a strategy that buys breakouts will thrive. But financial environments are dynamic. Eventually, volatility compresses. The macro participants shift their positioning, and the market transitions into a quiet, low-volatility regime. When the VIX drops below 15, the mechanics of price action reverse. Now, when an asset attempts a breakout, it lacks the participation to sustain the move and collapses back to its historical mean. The breakout logic that worked last month is now toxic. Unaware of this structural shift, a trader will watch their positions turn negative and exit early. They feel frustrated, assuming they have weak hands or lacked the courage to hold the trade. This is a misdiagnosis. That strain of losses is actually raw quantitative data. It is the market communicating that correlation patterns have changed and the mathematical edge is gone. Failing to adapt to a new regime makes psychological discipline useless. If the probability of a trade working no longer exists, the underlying edge has been neutralized. The second pillar, building on strengths, focuses on the neurological hardware of the trader. Execution fails when a trader hits a physiological barrier known as cognitive overload. The brain simply cannot process the incoming data stream fast enough to make a rational choice. High-frequency traders operate on 3-minute holding periods, bombarded by order flow dynamics and depth of market screens updating in milliseconds. Surviving that chaos requires a highly specific cognitive profile. These individuals excel at fast twitch processing, identifying shallow, real-time patterns across massive datasets without hesitation. Compare that to a macro investor. Their holding periods span months or years. Their advantage comes from deep, slow, analytical synthesis, piecing together obscure economic data that the rest of the market ignores. This scatterplot maps processing speed against time horizon. To succeed, a trader must align their natural cognitive processing speed with their strategy's time horizon. When a deep, reflective thinker tries to trade rapid mean reversion, they hit instant saturation. The sheer volume of inputs overwhelms their working memory, leading to decision fatigue and system failure. Traders often diagnose this as a psychological weakness under pressure. In reality, it is a symptom of trading a time frame that is completely misaligned with their neurological hardware. The third pillar, cultivating creativity, shifts the focus from internal neurology to external strategy generation. The financial markets are incredibly efficient at eliminating obvious edges. Standard, textbook technical analysis setups inevitably degrade as their alpha is shared by too many participants. Thousands of market participants and algorithms trade the exact same patterns. This crowding degrades the setup until it no longer offers a statistical advantage. In this context, creativity is a strict quantitative necessity. It is the ability to identify fresh, uncorrelated opportunity sets before the broader microstructure discovers them. That might mean uncovering a unique relative value pair trade in an ignored sector, exploiting a pricing inefficiency that is completely off the herd's radar. Observing markets through fresh, non-consensus eyes is the exact mechanism that allows a trader to survive regime shifts. Without cultivating distinct creative analytical angles, a trader is essentially just providing liquidity to those who do. The final pillar, developing best processes, focuses on the rigorous mechanics of execution. Professional performance cannot rely on motivation or hype. These are unsustainable drivers for showing up to the screens every day. Trading institutional size also creates intense performance anxiety. The pressure to succeed triggers a physiological response that interferes with the process of performing. This display tracks the absolute dollar drawdown on a $200 million portfolio. Seeing a $2 million loss in absolute terms is psychologically paralyzing. The institutional solution is decoupling. Professionals mitigate this pressure by stripping the emotional weight from the capital. The dashboard now shows a shift to basis points and risk-adjusted efficiency via the Sharpe ratio. By tracking percentages rather than dollars, the trader maintains the same emotional neutrality regardless of the account size. This detachment is reinforced through 30 days of habituated repetition, turning these processes into an automated, subconscious best practice. True discipline is the engineering of a process so standardized that it renders emotional motivation entirely obsolete. This completed diagram shows the unified ABCD framework. It is a continuous engine designed specifically for alpha generation. To survive inevitable statistical drawdowns over a multi-decade career, one final structural mandate is required. A trader's core identity and sources of fulfillment must not be entirely tethered to their market performance. Without an external anchor in life, the immense pressure of institutional drawdowns will fracture even the most perfectly built cognitive models. The ultimate psychological edge combines an optimized cognitive architecture with total professional detachment, allowing the trader to operate the machine without being crushed by it.